Thomas, how much of an X factor is this debt ceiling debate, given all the other pressures on the economy, and how much we've got to feel this lag effect of some pretty big rate hikes?
Yeah, I mean, the debt ceiling is kind of an annoyance, I think, for the market, right? I mean, but I don't think the cuts that the House have proposed is going to do anything. They're proposing a very small set of cuts on discretionary spending. Discretionary is about 25% of the overall budget, and the rest, 75% of non-discretionary, is going to grow far more than those cuts in the discretionary. So I think, regardless of whether the House gets what it wants or not, we're going to have a future, piling on of the debt, and that's for your long-term investors. It's going to be monetized sooner or later, probably. So it's going to be more inflationary pressure in the future coming out of this.
Yeah, you're looking farther down the line than I just wonder what this is going to do if in June, July, the markets have to digest it. But, okay, beyond that, in the nearer term, what do you see happening with the banks, particularly the regionals, that so far in their reports, things have been calmer than some feared?
Yeah, I mean, we saw a lot of depositors going from small to larger banks, right? They got scared, and they know the larger guys are more protected by the government with, too big to fail kind of policies. That kind of translated in the big guys' earnings are not taking a hit at all, and the smaller guys are kind of wobbly. It looks like less of a growth than the big guys, certainly. But we're kind of seeing a side effect, I think, of a too big to fail policy, which is that, once you have that in place, everyone wants to go to the big guys, and you get more concentrated markets in banking, which ultimately leads to lower payments on rates for depositors and higher rates on loans.
Thomas, I want to go back to something you just said before, and that is the future trajectory of spending in the U.S. and the monetization of that, and the fact that that is inflationary. What do you mean by that?
I mean, we saw what, once we have government have to borrow more and more, many times it's monetized. And I think the Fed is, suppose the Biden budget actually got passed, even though it has no chance of passing, obviously, with the House. But suppose that's the case, we would have a massive amount of new borrowing taking place that presumably part of it would be monetized again, just like it was in 20 and 21, essentially, which would put more pressure. And on top of it, they have a balance sheet, which is now increasing again. It went down from 9 to 8 trillion, and now it's going up to again because they're bailing out the banks with the liquidity, essentially. So there's no question that if you keep these spending levels that are talked about, that we will have some monetization of the future borrowing.
So where do you think the economy's headed then, as the Fed has hiked interest rates? And yes, maybe we get one more hike. We'll see what the data brings, especially next week, which I know is going to be a big focus for the markets, especially with the Fed in a blackout period ahead of its meeting. But when I hear you talk about that, I mean, is stagflation on the table? Hard landing, soft landing? How do you see it?
I don't see that, the naming of what's going on so important. What I think is important for the big chunk of people in the U.S., the middle class, is that we had basically real wage growth that on a 12-month basis been declining for the last 2 years. I think everyone thinks that's going to continue in Q3 and Q4 because essentially, even though inflation is going to come down, nominal wage growth is going to come down as well because of a recessionary pressure, essentially. So we will continue likely to have negative real wage growth going forward, just as we had in the last 2 years.
Finally, Thomas, do you think we're feeling yet the full effects of those three, in particular, 75 basis point hikes?
Yeah, I mean, we have housing and, every interest-sensitive sector is kind of responding, right? Housing is clearly in a recession. You see that in volume a lot more than prices because when you basically have high mortgage rates, no one wants to sell their house either to take a new mortgage on a new house. So you see both demand and supply coming down with those rate hikes, which have offsetting effects on prices. But you see enormous drop in volume. So, mortgage applications are down a third, refinancing is down 2/3, et cetera. So we're really in a housing recession, obviously, and that's the most interest-sensitive sector. Other sectors are following. But, for inflation, the non-housing sector is what's still keeping it up.
All right. So we're starting to feel it, maybe not full effects yet. Thomas, thank you.